Well, for more on what's happening on the markets, let's bring in Will McDonough, founder and lead portfolio manager at EMG Advisors. Will, thanks so much for joining us this afternoon.
Nice to see you again.
So we got this jobs data both in Canada and the U.S. I know markets focus in on the U.S. jobs data the most. What do you make of what we saw in the U.S.? It wasn't just about this month's number, but also about some revisions to previous months.
I was giggling this morning. My daughter Eloise's favorite book is Goldilocks, and it's not too hot and it's not too cold. It's just about right. I think that's what we're seeing out of the jobs data. They're just trying to thread this needle where it's not good enough, it's not bad enough, but it's not crazy enough that people have to trade away from it and it has to jar people. What did surprise me, though, is this is every time when they announce the new data, they kind of try to sneak in under the wire the fact that they're revising previous data. And I think 9 out of the last 11 periods have been revised down. And so I don't know really, how much to trust this data. It's skewed, of course, by the writers' strike. It's skewed by the labor unions and the auto industry strike. There's a lot of things that go into these numbers. And so I think that that's why you see the market not reacting so harshly to the news.
Yeah, so from a trading perspective, how challenging does that make things when there are all those factors to take into consideration? Plus, we know that the Federal Reserve is data dependent. It's talked about being data dependent. So on the one hand, you really do need to be focusing on all these different bits of data that are coming out, and the jobs reports are a big one.
The Fed does say that they're data dependent, but the Fed is always using old data. It's frustrating in today's day and age where we live minute to minute. We watch BNN Bloomberg and stay up to date on the markets. And then you have the Fed who's utilizing year-old housing data to make decisions on the rate environment. And it's just archaic and it's unfortunate. We liken it to adjusting the thermostat in your home. It doesn't react as quickly as you want it to. You can't be too abrupt with it because then it's going to be too hot or too cold, depending on where you wanted it to be. It takes time for this data to lag into the market. And so we can't react so abruptly to new news because we shouldn't react more abruptly than the data that the Fed is reacting to.
Some also old data, but new to investors is earnings results from companies. It's backward looking as well, but new to us. And we've seen a lot of big companies reporting in the past couple of weeks. We just heard from Apple yesterday, missing expectations in terms of sales in China, also on its MacBook. I wonder what you make of what we're seeing from Apple's results.
The scariest thing about Apple's results is just its concentration risk with China. When you look at 60, 70, up to 80% of their supply chain is in China proper. People react harshly when they see China sales down. Again, not a market that I necessarily trust all of the data that's coming out of it. But more concerning is the gradual understanding of the geopolitical risks that Apple has as a company with its ties to China, and should any duress occur between China and the rest of the world, what does that mean for Apple's ability to continue to deliver? I personally love Apple. I think it's very well capitalized. I try to look at the businesses that have large cash balances, that have staying power, that have easy access to capital markets, as those that are going to persist through trying times. And so that's more what I focus on when I look at the reports, is how much cash are they really sitting on, and can they be opportunistic as duress flows through other sectors that they participate in.
Now, another company that's on your radar, and many others will, is Berkshire Hathaway. And what will you be looking for from that company's results in terms of, understanding the environment that it's working in right now?
Berkshire to me is almost like an index of blue chip companies. Buffett famously buys companies that are tried and true. He's not a trader. He's not in and out of things. He also likes companies that have great brands and great cash balance sheets, like we reference Apple having. So when I see the Berkshire results come out, I hope that they're strong, because that is a portfolio of the companies that are tried and true, that are blue chip, that are going to be here to stay. And if we do see any duress in their portfolio, I think that would be a really nerve-wracking signal to send the market. And so I track the Berkshire results really closely as more of a macro indicator for the health of the healthy.
Just overall, when you're thinking about market direction right now, we were just talking about the benchmark Canadian index being on a bit of a run in terms of at least this past week, reversing a bit of a negative run the week before, though, Will. So, you know, when investors are trying to take in that kind of information that there are these, you know, these weeks of highs, but also lows right now. How are you kind of viewing things? How do you see the environment playing out for the rest of the year at this point?
I'm nervous about the rest of the year. You know, when you look at data about how much credit is extended, when you look at data about the rates that banks are offering on CDs versus the rates that are being offered in money market funds, you don't see a lot of capital staying in the system or being lent into the system. You've seen a lot of people spending stimulus money backward looking. And as we enter into this holiday season and people look at their savings account, they look at the macro environment, are they going to be buying the extra toy for their kid? Are they going to be, being extra generous with their Christmas bonuses? And so that's going to be, I think, also telling, but it's something I'm concerned about. I think that the Fed has been trying to force pain into this market for a long time, and I think it's time we took our medicine. So I'm predicting that we're going to have a hard Q4 and even harder Q1 of next year, and then hopefully leading into mid-year next year, they start to ease rates and they start to push capital back into the system so that we can get on more common ground and settled ground.